What was burn rate during the dot-com bubble? Imagine a time when internet startups were sprouting everywhere, fueled by endless enthusiasm and venture capital. During the late 1990s, the term burn rate became a buzzword that explained how fast these companies were spending their cash. It was all about how quickly they used their available money, mostly from investors, to keep their operations running. Since many of these startups had little or no revenue, their survival depended on how long they could keep spending before running out of cash or making a profit. The burn rate measured that time span, giving investors and founders a sense of how much runway they had left. In that era, many companies prioritized rapid growth and gaining users over making money. They spent heavily on marketing, hiring staff, and building technology infrastructure. Their goal was to dominate their market before they needed to turn a profit. But this approach came with big risks. If they burned through their cash too fast and couldn't attract more investment or start earning, they would go bankrupt. Companies like Petscom and Boo.com are famous examples of firms that had high burn rates and failed when investor excitement waned. A high burn rate meant a company had only a short window, sometimes just a few months, to prove its business model or find more funding. This created a tense race against time, with startups trying to grow fast enough to stay afloat. The faster they burned through cash, the more fragile their position. The burn rate became a symbol of the era's wild, speculative spirit and the get big fast mentality that defined the dot-com bubble. It was a way to see how much risk was involved in the rapid expansion craze. In practical terms, if a startup was spending $1 million a month, it had just a few months before running out of money unless it secured more funding or started earning revenue. This made every decision critical and added to the frantic pace of the late 1990s internet scene. The burn rate was more than just a number. It was a reflection of the optimism, the risks, and the bubble's eventual burst that marked that unique moment in tech history.